Here's a truth that most trading educators won't lead with. You can have a winning strategy and still blow up your account. A strategy with a 70% win rate will destroy you if you're risking 20% of your account on every trade. And a strategy with a 45% win rate can make you wealthy if your winners are 3 times larger than your losers and you size correctly. Position sizing and risk management aren't the sexy part of trading, but they are the reason some traders last decades and others don't make it through their first year. Let's talk about the math that actually matters. Before you worry about strike prices, expiration dates, or chart patterns, you need to answer one question. How much am I willing to lose on this trade? The standard framework is to risk no more than 1 to 2% of your total account on any single trade. This is the rule that professional traders and portfolio managers live by, and it exists for a very specific reason. It ensures survival. Let me show you why. Say your account is $100,000. At 2% risk per trade, your maximum loss on any single position is $2,000. If you hit 5 losing trades in a row, which will happen eventually, no matter how good your strategy is, you've lost $10,000 or 10% of your account. That's recoverable. Now imagine risking 10% per trade, 5 losers in a row, and you've lost half your account. To get back to break even from a 50% loss, you need a 100% return. That's a hole most traders never climb out of. The 1 to 2% rule isn't conservative. It's mathematical survival. Once you know your risk per trade, calculating position size is straightforward. For options income trades, like credit spreads or iron condors, your maximum loss is defined by the trade structure. A $5 wide credit spread where you collected $1.50 has a max loss of $3.50 per share, or $350 per contract. If your account is $100,000 and you're risking 2%, that's $2,000. You can trade up to 5 contracts. 350 times 5 is 750s, which keeps you under the limit. For stock trades or directional options trades, the calculation involves your stop loss. Say you're buying a stock at $50 with a stop loss at $48. Your risk per share is $2. With $2,000 of risk capital, you can buy 1,000 shares. If that's too large a position for your account, you adjust the stop or reduce the size. The formula is simple. Account size times risk percentage divided by risk per share equals your position size. Run this calculation for every single trade. No exceptions. For traders who want a more precise approach, the Kelly Criterion provides a formula for optimal bet sizing based on your win rate and reward to risk ratio. The formula is Kelly percentage equals win rate minus the quantity of loss rate divided by reward to risk ratio. If your win rate is 65% and your average winner is 1.5 times your average loser, the Kelly formula suggests risking about 41.7% of your capital on each trade. But here's the thing. Nobody actually uses the full Kelly. It's too aggressive and assumes perfect knowledge of your true edge. Most practitioners use fractional Kelly, half or even a quarter of the recommended size. Half Kelly on the above numbers would be about 20%, and quarter Kelly would be about 10%. Even quarter Kelly is aggressive for most retail traders. The value of Kelly isn't the specific number, it's the framework. It shows you that your optimal bet size depends on both your win rate and your reward to risk ratio. A high win rate with small winners requires different sizing than a low win rate with large winners. Know your numbers. Size accordingly. Individual position sizing is only half the picture. You also need to manage total portfolio exposure. A common guideline: never have more than 5 to 6% of your account at risk across all open positions at any given time. Some traders push this to 10%, but beyond that, a bad week in the market can cause serious damage. Why? Because trades can be correlated. If you sell credit spreads on 5 different tech stocks and the tech sector drops 5%, all 5 positions may lose simultaneously. Diversification across sectors and asset classes reduces this correlation risk. Another consideration: capital utilization. If you're running the wheel strategy or selling cash-secured puts, a significant portion of your account is tied up as collateral. Make sure you're leaving enough free capital to manage existing positions, rolling spreads, adjusting strikes, without being forced into bad decisions because your buying power is maxed out. A good rule of thumb is to keep at least 30 to 50% of your account in cash or cash equivalents at all times. This gives you flexibility to capitalize on opportunities and absorb drawdowns. Every trader experiences drawdowns. The question is whether you have a plan for them. Define a maximum drawdown threshold before it happens. For many traders, this is 10 to 15% of the account. If your account drops by that amount, you pause, you reduce position sizes, you go back to paper trading or single contract trades until you've identified what went wrong and the bleeding has stopped. This isn't weakness. This is the discipline that keeps you in the game long enough for your edge to play out. Think of it like this. A basketball team down by 20 doesn't start taking half-court shots. They slow down, tighten up their defense, and work their way back with high-percentage plays. The same logic applies to trading. During drawdowns, scale down. Trade smaller. Focus on your highest conviction setups. Protect your capital so that when conditions improve, you have the resources to participate. Here's a principle that ties everything together. Your risk-to-reward ratio determines how often you need to be right. If you risk $1 to make $1, a 1-to-1 ratio, you need to win more than 50% of the time to be profitable after commissions and slippage. If you risk $1 to make $2, a 1-to-2 ratio, you only need to win 34% of the time. If you risk $1 to make $3, a 1-to-3 ratio, you only need to win 26% of the time. For income strategies like credit spreads and iron condors, the ratio is often inverted. You risk more than you stand to gain on each trade, but you win the majority of the time. A credit spread might risk 350 to make 150. The math works because you win 70 to 80% of the time. For directional strategies like Gap and Go or ORB, the dynamic is reversed. You might win 40 to 50% of the time, but your winners are 2 or 3 times the size of your losers. Neither approach is inherently better, but you need to understand which paradigm your strategy falls into and size accordingly. Don't apply momentum sizing rules to an income strategy or vice versa. Let me leave you with 5 habits that protect your capital. 1. Calculate your position size before entering every trade. Not after, not approximately. Exact. 2. Always use a stop loss, mental or physical. For options sellers, know the point at which you'll close a losing trade and commit to it. 3. Review your portfolio risk weekly. Know your total capital at risk, your sector exposure, and your cash reserves. 4. Journal every trade, not just the entry and exit, but the reasoning, the sizing, and the emotional state. Patterns emerge in journals that you'll never see in real time. 5. Never increase position size after a losing streak to make it back. This is revenge trading, and it's the single most common account killer. Size up only when your equity has grown, and even then, do it gradually. Position sizing and risk management are the invisible framework behind every successful trader. Risk 1 to 2% per trade. Calculate your size based on max loss. Manage total portfolio exposure. Plan for drawdowns before they happen. Understand the risk-reward dynamics of your strategy. The best strategy in the world is worthless without the discipline to size it correctly and the resilience to manage it through rough patches. This isn't optional. This is the foundation. Subscribe if this series is changing how you think about trading. We're not just teaching strategies, we're building a complete system. See you in the next one.